When the U.S. central bank started pumping billions of dollars into the economy to stimulate growth, investors took advantage, investing money in fast-growing economies and countries where interest rates were higher. But amid signs of a strengthening U.S. economy, the Federal Reserve began scaling back monetary stimulus. As a result, in the World Bank's Global Economic Report, economist Andrew Burns says investments are flowing back into advanced economies as interest rates begin to rise.
The analysis that we do in the report suggests that capital flows to developing countries in a smooth transition to higher interest rates in the United States are likely to decline as a percentage of developing country GDP.
The exodus of capital comes at a bad time, as growth in developing countries from Brazil to India has slowed. When its currency declined sharply last month, Turkey's central bank tried to discourage capital flight, doubling interest rates to attract investors. That briefly raised the value of the Turkish lira, but economist Özlem Demirci says the cost is too high.
Of course, we will see some negative impact of this rate hike decision over growth, especially GDP growth, because the credit rates will probably increase, borrowing costs will increase.
Meanwhile, Argentina's central bank chose not to intervene, resulting in the Argentine peso's biggest depreciation in more than a decade. The contagion spread quickly to other emerging markets, leading some economists to call it the biggest sell-off in emerging market currencies since 2009. William Klein at the Peterson Institute says you can't blame all of it on the Fed's taper.
In Argentina, they had domestic inflation that was running very high, and it was disguised by the official figures. Turkey, political scandals, and a very large trade deficit.
Given those country-specific issues, Klein says the recent market turmoil may be a necessary correction. One example he cites is Brazil.
After all, it was fairly recently that the Brazilians were complaining about a currency war. And they were saying that this wall of money coming at them because our interest rates were so low were making them uncompetitive. Now I think that their currency is more appropriately valued.
On the other hand, China, the world's fastest-growing major economy, has been largely unscathed, perhaps owing to its large dollar reserves. But given the interconnected nature of commerce, economists say the turmoil in emerging markets isn't over yet. Mil Arcega, VOA News, Washington.